Welcome, ladies and gentlemen. What a morning I have had. OBS updates itself and then just gives me this madness. My Stream Deck doesn't even work, so I can't even switch between programs. Never mind. But we've got ourselves a very interesting start to the week, ladies and gentlemen. We've got to understand that this week is Labor Week. What do we mean by Labor Week? Well, we're going to know exactly where we stand with all of the labor market in terms of data that is being released. Now, we're talking about the labor data that's coming out. We're talking about the potential for a government shutdown because of Donald Trump's stance with regards to illegal immigrants and the benefits that they are seeking. He doesn't want to do it. Congress is trying to battle that, but never mind. So we've got a pending government shutdown that's on the cards. But the bigger thing right now, ladies and gentlemen, in the marketplace is this. Are we going to get the rate cuts? That's what we're focusing on. And it's all going to be data dependent. Of course it is. Now, this week, we are filled with lots of data that is going to be released, which will set the path for interest rate cuts going in towards the end of the year. Now, if we don't get the data that the market is anticipating, then investors are going to start scaling back the idea that, okay, maybe things aren't as good as they appear to be. And what I'm going to do in this live stream, ladies and gentlemen, just break it all down for you and help you understand what to be aware of as we are getting to the idea of, are we getting more rate cuts? Is there going to be a pause? I mean, one Fed speaker today come out with the idea that we need to maintain sort of a mild restrictive policy. What on earth is going on? Why are they coming out with restrictions all of a sudden? Aren't we in the easing cycle because they've cut the rates? So we're going to break it all down for you today, ladies and gentlemen, and hopefully make sense of that madness. Mad love and respect to everyone passing through. See you in the next quarter. Tino, Safe Haven and risk on assets are both pumping. What is going on? Exactly. When risk on assets are pumping and safe haven assets are pumping, you can tell that there is a transition. There's a rotation happening, and you just need to be very careful. But let's make sense of it right now, ladies and gentlemen. Here we go. So in front of you, Bloomberg today, gold. Well, ladies and gentlemen, gold. I mean, let's just quickly go over and have a look at gold right now. Where are you? What is going on here? Here we go. So gold has clipped its 3,832. The high of there. I mean, look at that. It's just not stopped going up in the Asian session. And the only reason why gold is going up because of the following thing. Interest rates are anticipated to be cut. And you've got to understand, when we go to interest rates right now, you go over to the 10-year bond market, you can see it's starting to pull back, but it was trading positive this morning, 0.1%. 2-year yields were trading negative, so that was okay. And then, of course, you've got the 5-year and the 10-year and the 30-year. They're all trading sort of negative right now. However, if you look at the way the yields in the markets are actually behaving right now, the 2-year is sort of moving upwards right now. And you can see it's been going up for quite some time, which means that the expectation from investors is interest rates are going to be higher for longer. Okay, so if they are higher for longer, then that means investors aren't going to be going into the bond market because they're thinking maybe we could get a better yield in the future. So we're going to wait and see what the market is going to do in regards to interest rates. We need to wait and see if Powell and the gang is going to give us those rate cuts or not. If they're going to give us the idea that we're not going to get rate cuts, then I'm going to wait for a little bit longer and lock in a higher rate of return on the yields. So if you go to the 10-year, you can see it's moving up now at 4.16%, and it was a high last week of 4.2%. So that meant that investors expected that the interest rates were going to be higher for longer. Remember, we've just come from 4.5%. Now we're at the 4.25% region, but investors are sort of believing that maybe we could end up being higher for longer. Now, look at this. Going into the article, it says here that the stocks rose at the start of the week because labor market reports that are due to be released is giving the idea that investors are trying to put together the idea of the Fed being dovish, which means that they are expecting to cut interest rates and be a little bit more relaxed in regards to interest rates. But we've got a little bit of a problem, ladies and gentlemen. Look, this is the calendar for this week, all right? So we just go into that, get rid of this, and this is where we are this week. Tomorrow, it starts with the JOLTS job openings report. They're expecting 7.15 million, a reduction in jobs being offered by big major companies, okay? Next, ADP non-farm employment changes expected to come in at 53,000. That is horrible. Look at the ratings that they've had so far. Look at this. There's no consistency in the marketplace of the labor market. They're saying it's cooling off, but you can just see that it's not negative. It's not positive. It's mainly negative. But this wild reading of 104,000, it's like people are like, hold on, are we getting jobs or not? Okay. And this is the data that the Fed's trying to work with. On top of that, unemployment claims came in last week at 218,000. That was a blowout figure. They did not expect it to be coming in so low, in the sense they expected more people to be claiming benefit. That wasn't the case. Now they're expecting 229,000 more people to be claiming benefit. So if there are more people claiming benefit, then the idea is that the Fed has to start cutting rates. Now, going into it, this week is non-farm payrolls. And when you see a disconnect in the marketplace where the assets of everything are just shooting up, like the gentleman asked, Tino, safe haven assets and, of course, risk-on assets are moving up, is it because they are actually preparing for bad news? What is bad news? Well, look, listen, bad news is if the labor market is contracting and less people are working, that's a problem for the economy. But it's good news because then that means we're going to get interest rate cuts. So then investors or the market will price that logic in. Okay. Now, with that being said, let's go and have a look at what's going on across the board to help you understand what's going on. In front of you, it says here, top investors shift from AI stocks to government-backed sectors. That is a problem for me. That's no good. Why? Because if you're shifting from AI stocks, given that AI has been the primary reason for why the NASDAQ has been climbing up so much, and they're going into government-backed sectors, what are those? Defense-based stocks like aerospace and defense, medical. If they're starting to transition into that, it means that the market is starting to believe that maybe we actually are going into a bit of a problem. Maybe rates are going to stay higher for longer. With that being said, let's just go and dive into a little bit of data, ladies and gentlemen. This week is the non-farm payroll data. It's the most biggest reading of where we are economically speaking in the United States. In front of you is the reading of the non-farm payrolls yearly change versus the US real GDP. Okay, so that's the gross domestic product. Now that's come in at a reading of 3.8%. So we know that the US economy is expanding. It's doing great, right? This blue line is the non-farm payrolls. What is it showing you? Showing you a trajectory of downside movement. So that means less jobs are being available, right? Says here that in the past 30 years, whenever the non-farm payroll yearly gain is less than 2 million and followed by an even smaller gain, the market would be cautious of sluggish economic growth or even a recession. Now you can see there in this shady area, can you see these like gray shades? Those are recessions, okay? So what really blows my mind is for every time we've seen a contraction in the non-farm payrolls, it has led to a recession. What does that mean? It's been going down since what, 2022. So for the best part of nearly 3 years, non-farm payrolls reading has been trading lower. So less jobs are being provided. So where are they getting this data that the US labor market is great? Is the data cooked? So from this view, is it possible to assume that we could actually be getting ready to see the US going into a recession? I'm just spitballing here with you all, ladies and gentlemen, because it's going to help you understand whether you should be buying crypto now or not. Okay? But the labor market is showing signs that it's going down and it's trading below 2 million. Where are we at now? 1.466. It's contracting below that amount. So less jobs are being offered, which naturally does lead to, we haven't had no recession. What the hell's going on? Naturally, we need to see the market contract. GDP. Look at it. Downwards. And we had a little bit of a burp right here at 3.8%. Is that because of the tariffs? Is that because of all the money that's coming in from tariffs is causing this to go up? And it's not really a sustained thing for the economy. It's just the cash injection. That's it. You still got the deficits going up, and that's still climbing. Remember, Besant, what did he say? We don't have to worry about the debt ceiling. We've rose that again. So 2 years, we don't have to worry about it. I mean, what is that? They keep increasing the deficits. That's why investors are demanding more of a rate of return when it comes to the bonds market. That's a bit of a problem. But NASDAQ up 0.64% for the day. Not bad. A nice little drift to the upside in the Asian session. Very, very close to its all-time highs. Okay. Now, look, with AI being such a big thing in the marketplace, we're reading articles like this. Semiconductor equipment stock momentum will continue. That's what Deutsche Bank say. So semiconductors are still the thing, ladies and gentlemen. So pay attention to semiconductor stocks, and I've got something for you. Now, in front of you is the iShares Automation Robotics ETF. Okay. Now, with the Platinum members, I've shared my stock list on the stocks that I'm actively buying and paying attention to. And I'm going to keep those guys updated because what I'm doing with that is I'm creating a portfolio that is adjusting to the changes in the economy and the marketplace. All right. So you want to check that out. Go to the Traders Reality website and you'll get access to that information as a Platinum member. Now, this is for anyone that wants to dive into the environment when it comes to tech. All right. At an entry level, in my opinion. Now, this RBOT, now just be careful. RBOT is also the name of a stock over here. Where is it? RBOT. It's the name of a surgical company, right? That they make robotics for surgeons, right? It says here, develops miniaturized robotics, computer science, 3D visualization to build single incision surgical robots, all right? And it's a very cheap stock, but don't get it confused because it's got the same ticker symbol as this iShares one right here. Now, I just want to give you this as an example of what to be mindful of. This ETF is made up of, in the holdings, it's made up of mainly companies that are information technology based. So tech stocks. You can see you've got Intel, AMD, Advanced Micro Devices, you've got NVIDIA, you've got Garmin, Autodesk, Siemens. It's made up of these companies, okay? And what you're doing there is all these companies have something to do with robotics, all right? And you're only trying, rather than investing all your capital into one of these companies, because if you look at NVIDIA right now and looking at the price action of it, you say to yourself, is that overvalued or not? Well, you look at it, it's trading at its all-time high, it's near enough, it's in massive consolidation. I do believe that NVIDIA is going to break out. I do believe it will, but it's going to be based on triggers of interest rate cuts or not. Okay, so just take that into consideration. But as an ETF, and this is something you've got to understand about ETFs and the differences with ETFs in cryptocurrency and ETFs in the stock market. An ETF gives you the luxury of being able to take advantage of the risk across Intel, Advanced AMD, NVIDIA. It's a money market where it says rather than investing in just one share of NVIDIA and one share of Intel, well, looking at the prices of those, they're quite expensive, okay? You might not want to invest in all of them, but if you invest in an index of stocks that make up the idea of robotics and you're into that sort of thing, given that NVIDIA has spoken about the idea that it wants to get into humanoid robotics in the future, all right? Even a car, like, you know, it's all coming out. Something like this could put things into logic for you, and an entry level, given that it's at $15, it's going to make it easy for you to manage, okay? So if you don't want to take on the risk of getting into a stock individually, you go over to an ETF. That's why there's roughly around $7 trillion sat in money markets, which are waiting to get pulled from these money markets to go into the stock market. But because the stock market is so overvalued right now, investors are a little bit reluctant to do it because we don't know where we are with the rates for interest rates. Now, going into it, this is where we are with the Federal Reserve and the rate cuts. As it stands, we're currently getting a reading of around 82%. Here we go. Sorry, 89% of investors believe that we're going into 3.75 4% on the interest rates. Problem is the data that we get this week is going to dictate whether that reading is going to be staying at 89 and going higher with the anticipation of a rate cut, or the interest rates are going to be held. There's a possibility that they could hold off the interest rates if the labor market does not show weakness. You need negative readings on the labor market because by this logic here, it says that the labor market is contracting. Fine. But is the economy contracting? Because equally, when the labor market contracts, the economy contracts. But the problem is we've got a labor market that's contracting, right? You've got a GDP that is expanding. All of a sudden, tariffs, companies putting money into the US, billions of dollars of commitment coming in. You don't want to pay 100% tariffs? Start building your factories over here. That's what Trump's saying. That is giving liquidity into the marketplace. Every dollar that the US earns, they owe 126% on top of it. So whether they do put money into it or not, The US is in a little bit of a tricky situation, but investors don't care because the stock market is going up. But because investors believe the interest rates are going to get cut, that's why you're witnessing gold making these significant moves to the upside. Investors are pricing it in now. They are pricing that logic of gold interest rates being cut right now. Okay? Now, going into the story of cryptocurrency. In front of you, spot Ethereum ETFs lost 796 million last week. Let me explain something to you about ETFs in crypto and the ETFs in the stock market. Remember, an ETF is made up of a holdings basket. It's a number of stocks that represent this ETF. So like the robot one that I showed you is companies that are involved in robotics or anything to do with information technology. So they put it all together in like an index, and then there you have your ETF. It's priced at $15 at entry level. It's all good for you to get involved in and start accumulating shares on the prospect that in the future, robotics is going to be a thing. So you're going to be involved in that. The problem with cryptocurrency ETFs is you're just relying exclusively on the asset accumulation itself. It's not taking anything else. So a Bitcoin ETF is based on what? It's just based on someone buying Bitcoin. There's no holdings. It's just the Bitcoin holding itself. It's not taking an ETF like a cryptocurrency ETF would be. Let's base it exclusively on just altcoins, okay? So if you had an altcoin ETF, for example, then you would pull out the best performing altcoins. I'm not even going to include XRP, but imagine you'd have Ethereum in there. You'd probably put Solana in there. You'd probably put Link in there. You'd probably put BNB in there. You'd take all those and say, okay, this ETF called crypto ETF is based on the holdings of the performance of these several altcoins, okay? But the problem is cryptocurrency ETFs are just about the person or the actual asset itself being accumulated. You're relying on people buying it and selling it. Where's the longevity for it? There's nothing inside of the ETF to back it. That's the problem. Because you're buying ETF for NVIDIA on the idea that NVIDIA is going to be doing great on its earnings and sales. It's putting out lots of chips. It's forever expanding on research to try and create the best computers ever, okay? So that's one company you can rely on. Then you've got Intel. Intel is working onto quantum-based computers. Sorry, IBM, for example. So we go over to here. Where is it? IBM. There's a new potential quantum computing king, and it's IBM right now. So IBM is getting into the space. All right. So imagine you had an ETF that had the holdings of IBM, NVIDIA, and Advanced Micro Devices, and of course, Intel. All right. You can back the logic up because there's a service, people consume it. And as long as those stocks are getting consumed in terms of the businesses that they're providing and the services they're selling, then naturally your ETF is going to increase in value because those stocks are performing well. Problem is with cryptocurrency, you've got a different story right there. Again, Ethereum. That's just taken a loss of 796 million. That's quite a bit of Ethereum to come out the window. Looking at cryptocurrency for Bitcoin, you can see that the ETF balance itself is coming in at 768,285. The problem is there's no reason for people to hold cryptocurrency ETFs other than the expectation that price of it is going to continue higher. That's not enough to keep an investor in the asset. What keeps him in the asset is the idea of speculation, which is why the balances keep on going up and down in cryptocurrency. Now, we're all waiting for this Solana ETF that's coming into play, all right? So, for example, look what you've got today. You've got Bitcoin trading positive at 0.04%, which was higher earlier on this morning. And then you've got Solana trading negative 2.27%. You've got now Ethereum trading down 0.92%, okay, which was trading positive earlier on this morning, okay? But the problem that we've got with it all is cryptocurrency ETFs are not backed by anything. You're relying on the idea of someone buying it and selling it. That is it, which is a little bit of a shame, really. But with cryptocurrency, given BlackRock, again, yes, BlackRock hold quite a bit because it's institutional players, but using this ETF, all right, to short it on the futures, right, and buy it on spot. That's why this ETF has been created, in my opinion. Because there's no purpose of the ETF. Compare Bitcoin's ETF relative to something like this. What's the holdings? Look at the performance of it, all right? You get so much information on the ETF. Now, what I'm saying to you is not to put you off the idea of buying the ETF. is to get you to understand the importance of why Bitcoin's ETF value always fluctuates. It goes up, it goes down. There's no longevity in it because they're always buying and selling, okay? And sometimes it can give investors a little bit of a fright because they don't want to be exposed to that volatility. The ETFs, in my opinion, are designed to give hedge fund traders or traders overall the opportunity to exploit it. So buy it on spot, all right, go to an exchange and then go over to the ETF, or sorry, short it on an exchange on the futures market and buy it over there on the ETF because hedge funds don't have the access to buy the coin itself, okay? They may not be able to use leverage on certain unregulated exchanges because cryptocurrency is it's unregulated, ladies and gentlemen. And crypto becoming an ETF itself, or Bitcoin, is really the first step to get cryptocurrency encouragement from the street itself. But you can see with the way the balances behave. I mean, BlackRock last week was selling quite a bit. We've just seen 3 hours ago, they didn't really buy anything, just bought a little bit of Ethereum. Don't understand why, but there you go. They've sold 3 hours ago. Ethereum, 10, 20, 30,000 Ethereum. The ETF itself, and then another 10,000, and then 40 Bitcoin was sold, 300 Bitcoin was sold 3 hours ago. So you can appreciate, again, they're offloading this thing, and then you go over to price and say to yourself, hold on a second, why is price going up if they're selling? Because retail's coming in and buying. We've established that. Look at your charts. Bitcoin, what you got here? You got participants coming in wanting to sell the Bitcoin. Offers, zoom out a little bit. Well, offers have actually started to disappear. They've done a nice sweep. Look at that. 23 million was sold at 112,200. So what that looked like as a breakout, okay, has trapped traders, but they've sold a bit of liquidity in the crypto markets. All right. So again, if you can keep in your mind that the ETF balances that are fluctuating, cryptocurrency ETFs are purely, in my opinion, designed for hedge fund managers to really exploit price fluctuations. They do not give two damns about the idea of cryptocurrency. That is the coin for the man as such. They don't care about decentralization. All right. So just take that into consideration when you are playing the idea of Bitcoin and the ETF. It's just an asset. It's a financial instrument to allow someone a means to an end. Okay. So if you're wondering why they're selling, if Bitcoin's being primed to pump, okay, why on earth would they be selling? Just goes to show it doesn't matter. For them, it's just about the bottom line and the profit that they can earn from it, okay? Another thing you want to take into consideration, Citigroup's come out with this story about stablecoin markets. Interesting, huh? So, Citigroup projects stablecoin issuance to reach 4 trillion by 2030. 5 years, ladies and gentlemen. 4 trillion, okay? Current stablecoin market cap is approximately 296 billion. To back that logic up, where are we? DeFi Llama, check this out. As you can see right now, it says here, stablecoins market cap is coming in at 296 billion. Not bad. We know a couple of heavyweights that we look at. We go into it all. Let's have a look at Circle for a second, see where we are with that. Circle, come on, where are you? We go. So how have they been performing? Well, Circle is currently up 1.82% in pre-markets, $129 a share from a close of last week at $126. Quickly going into bullish, because these are our holdings, ladies and gentlemen. Let's have a look at holding. There we go, $63.30. Okay, that's not doing too bad. It's up 1.13%. So we're all good with that. Of course, when these guys are going up, the stock market is trading positive. That's usually what's going to be happening in the marketplace overall. But if we just go over to DeFi Llama and have a look at the liquidity, you can see 296 billion in the stablecoin market. And overall, you can see here that total value locked in DeFi. It's still climbing up. Just want to quickly touch base on a couple of things. Chronos, just want to dive into that. Starting to see a little bit of a contraction from there. So people are looking like they're starting to pull money out from that story, given that they had that little venture with Trump media as such. But yeah, for me, long-term, crypto.com or Chronos is going to be a big thing, ladies and gentlemen. You only just need to go into the app to understand what they're trying to do. They're going to try and do stock, tokenized stock offering and what have you. And that's where cryptocurrency is effectively going to end up going. And then that's where you're going to then see the ETFs that are going to be hitting out to institutional investors that are made up like this, okay? It's going to be based on ecosystems in cryptocurrency. There are companies that do offer that, but we're talking about main big issuance of ETF providers like BlackRock. Wouldn't it be great to have a BlackRock ETF that's made up of just the top performing 20 altcoins? Or if you want to have a look at stablecoin ETFs, when we'll throw XRP into that, jokes aside, you get the idea. But just putting that into perspective for you all, ladies and gentlemen, just take into consideration this chart, this DeFi Llama story. It shows you the liquidity and it shows you activity. You start seeing activity happening on a certain chain, then get involved in that chain. Go to Solana. Look at this. Solana, it's just made a high, it's come back down, okay? There's activity happening on Solana. Of course, with the ETF for Solana, whales are accumulating it. And I do believe Solana is going to keep moving up. And I also believe that Solana only really moves, okay, when meme coins start to get traction. When we start getting a meme coin hype, Solana starts to move. Go back and look at when Trump was coming into power and all those meme coins like Trump coin, Elon coin, and all that stuff was coming out, and JD Vance coin. When those coins were coming out, the original coins as such, those meme guys were creating, it was fueling Solana activity, right? So when you see the activity, head over to Solana. When the meme coin market is really going, Solana is really going. But after that, when that activity dies off, what does Solana do? It doesn't do anything. So in other words, it relies very heavily on the catalysts of players in cryptocurrency. Is that sustainable? Yeah, it's got cheap fees and what have you. But there's loads of cryptocurrencies out there that offer cheap fees. Look at XRP. Why isn't that at $1,000 if it's so cheap to transact? Shouldn't everyone be in the XRP? So it makes sense that you've got certain coins that behave certain ways. And that's really important to understand when you're going to try and invest in it and the reasons for it, okay? Quickly going over into Bitcoin and understand where we are with price action overall, where we at with the time. Here we go. So it's 1/2 the market has opened up right now, ladies and gentlemen. So looking at Bitcoin, we're currently stuck in this range right now. The market is open. Just having a look at where the NASDAQ is, you can see it's just doing this weird sweep lower, sweep up. That's usually standard. The VIX is currently trading positive right now at 0.22%. So some people are looking to actually hedge themselves. Quickly going over into the euro. The euro's making a nice little pump to the upside off the back of the idea that the dollar dominance is going to pull back, because I believe that they're setting the market up for, I believe this week they're setting the market up for surprise readings. I think we're going to get stupid readings on the labor market. It's going to show that there's more jobs available. Everything is doing great. And that's going to really rock the idea of interest rates being cut, ladies and gents. So just take that into consideration. Quickly going over into Bitcoin in terms of liquidations and all of that fun and games. Let's have a look where we are right now. So as we saw in the heat map, you can see here, you've got open interest down there on Bitcoin has been tested from the weekend, and it looks like it's made the nice move to the upside. We did see a lot of participants coming into play on Bitcoin. If you look on the bottom right, it's triggered the history right there. So it seems like this area here at 109,000 seems to be a massive spot for Bitcoin players to get involved, okay? But the issue is, if we're seeing a lot of dumping happening on the ETF, it only means that they're selling into that strength, which means that breakout traders are currently committed and they're going to start building their positions to the downside, or in other words, leverage is coming into play, which could equally have an impact on Bitcoin coming back down. Now, the question is, how many of you believe that this is the only time that Bitcoin is going to get ready and primed to move to the upside? Remember, I want to see Bitcoin come back up to the all-time highs, and I do believe it's going to do that. And October, being October, is going to be something that we're expecting. What we need to see happening is Bitcoin clearing this high right here of 117. The only way that's going to be happening is if the data comes out this week, and especially non-farm payrolls. It needs to show that the Fed has got a problem with the labor market, but it's a problem, in my opinion, that they already know is an issue. They just don't want to declare it. They don't want to look like they're doing it wrong, because they've already moved the goalposts for inflation, because they're not focused that on anymore. No, they're not interested in it. They're interested in the labor market, and rightly so. No recession, your labor market is contracting, and you're not getting the consistent results from it. Remember, last week's unemployment claims came in lower. It's meant to be struggling. That's the idea. And your GDP is out the window. It's not consistent. Out of nowhere doesn't make sense. Okay? Cool. Any questions? October, feed the hype meme it. There you go. October. Got it. ETH moved $1 today. Cool. Tina, I had an order at 3,800 on ETH and I missed it. Do you think that 3,800 was the bottom then? Do I think this is all the bottom? Look, this is the weekly, the daily time frame for Bitcoin, okay? Bitcoin has tried to come down towards this area here around the 108. Is this the low for Bitcoin? That's the question. What we need to see Bitcoin doing is coming away from this consolidation area, all right? It has to clear the 117,000 because that would improve massively the odds of it going up towards the all-time high. It's a data-driven market. They get good news, everything pumps. They get bad news, everything stalls or drops. Okay? Check this out. In front of you is the percentage of cryptocurrencies above the 50 and the 200-day moving average. This is important. Says here, when you look into it, just zoom in. It says here that this is a percentage of cryptocurrencies above the 50-day, right? It shows that 25% of cryptocurrencies are trading above the 50-day moving average. 25% of cryptocurrencies, right? Then it says that 50 or 49.66% of cryptocurrencies are trading above the 200-day. And that's gone up from 42.28 to 49.66, okay? So that means that there is activity. Some coins are moving up, but only 50% of the cryptocurrency market is trading above the 200-day moving average, right? The logic says that for every time we start hitting the high percentiles of the cryptocurrencies trading above the 50 and the 200-day, it means that we're heading into an extreme range, or there is extreme optimism. 200-day right there is it's not even above 50%. So there's obviously still room for cryptocurrency to move up. Crypto, just looking at this chart, does it mean that you just go all in right now? Not necessarily. Cryptocurrency can easily move up to here and roll over, all right? It's still inside of a resistance. What we need to see happening is crypto will move up when the data gives them a reason to believe the rates will be cut. That's when crypto will move up. Hands down. So if you want to know why Bitcoin will move up, it's not because whales are going to buy it. You want to ask yourself, why the whales buying? Are they buying because they think it will go up? No, they're buying because they think the interest rates are going to get cut. That means they can borrow more money and put it to work. And if investors have an expectation that the yields should be higher, look, if the yields are turning higher, right? If they're going to start working up, that means the expectation of interest rates in the future ain't low. They're expecting them to be higher. If this reading right here comes down, that's no good, right? So as long as the data this week, what I'm saying to you is, as long as the data this week shows struggling in the labor market, from a data perspective, that solidifies the idea of rates being cut. Cryptocurrency will pump. That's all it is. Because we are in a data-driven environment. Powell said it. We need to have more data to justify the rate cuts. And all these Fed speakers are coming out with different tones right now. They're not really setting the precedent for, yes, we should be cutting, and what have you. All right? They're all up in the air with it. So just take that into consideration, ladies and gentlemen. Remember, you're trading the news. You're trading sentiment. All right? Take that into consideration. Okay? Cool. I've been listening to Livermore, validating your system over and over. My only suggestion is maybe talk more about sizing and the impact on your day trades. Listen, the more size you use, okay, the harder it's going to be for you to give your asset a chance to move. Just look at Bitcoin, for example, all right? If you guys, I'll put it to you like this and I'll let you guys go. What time is it? Yeah, I'm going to have to make this really, really quick, okay? Look at this. Just to put it into perspective for you all so you can understand where I'm coming from, right? Here we go. Look at this. These are the liquidation levels for Bitcoin right now, okay? With 100x leverage, 200x, whatever it is, okay? Now look. These are longs, right? These are shorts. The darker the color, the more margin. So you can see that we're heading into a high margin of short sellers, okay? Now, down here, you've got these traders who are using lots of leverage, low margin, right? Look at how close these participants have been getting liquidated, man. Just look at it. These guys have been going long here, right? And look where their liquidation points are. It's very close. Bitcoin can easily drop 2-3 grand in a day. Easy. And it can initiate stop runs like that all the time. Okay? If you're taking a long from here, like this guy who went long at 112,262, and your liquidation point is 111,641. Well, you're not really giving yourself that much freedom now, are you? No, you're asking to get liquidated. Okay? Look. Imagine all the people that went long up here. 112,514. all the way down to 111,900. Now, that's about a $500-600 move in Bitcoin. You might not think that's a lot, but look at where it is relative to all the margins. That's the thing. So if you're going to run along from this range here, where's your exit going to be? Make sure you always don't risk too much money, and make sure that you keep your risk tight and don't get shaken out. Hold on. You can't be expected to run along from here, okay, and have yourself an exit like this. That does not make sense, because Bitcoin will just eat that no problem, okay? The lighter trade size you use, the more freedom you can give the asset to move. If Bitcoin's been primed to move up, right? But the volatility of it sends it all over the place and keeps you thinking, oh my God, where's it going to go, right? Well, you say go long from here, hypothetically, right? And if you're going to aim for lighter size, you've got to factor in a wide range. But equally, with lighter positioning, you can aim for a bigger move. People make the mistake of thinking that the bigger size you use, the more money you're going to earn in your trade. That's correct. But you've got to factor in the bigger size you use, the more freedom you have to be able to give it. Does your size allow you to replicate that same drawdown? Can you put down size on Bitcoin and absorb from this entry point here, 112,500, can you absorb nearly a $2,500 move on Bitcoin? Can you absorb that? Nearly. Let's just say, okay, just round it off to 10,500, 12,500. Can you absorb that on high leverage with high margin, for example? If you can absorb it, happy days. But most traders come with high leverage, low margin, and they don't really give themselves the ability to actually absorb that risk. The lighter you trade, the longer you get, the more information you get about being right or wrong. Because then when it works in your favor, what are you going to do next? The logic says that when price breaks out to the upside, for example, rise, you want proof of the breakout because they've just broken out of this range. Retrace. I'll take and retrace because that's going to tell me that my small position is in profit right now. It's made a move to the upside and it's pulling back. If it's going to load up any more, it's going to go higher. Happy days. You add on the retrace. If it shoots up, then shoots straight back down again, and you're still in the one light position, you haven't lost anything. At least you're paying to understand the strength of the move. That's why you should always probe your bets. Okay? Cool. With that being said, ladies and gentlemen, mad love and respect. I've got to make a move, but I'll be tuning into you all later on. Please trade safely. Peace.